Hi, welcome to Numerics Video Blog. I'm your host, Jim Jockle. Joining me today, old friend of the blog, Kevin McPartland of Greenwich Associates. Kevin, how are you?
Great, Jim. Good to be here.
Happy to have you back here at Numerics Next 2017 in beautiful Rye Brook, New York. You're about to talk to the Numerics audience of, I think, probably about 130 people on trends in fixed income market making, and on the back end of a new report published on GreenwichAssociates.com. Tell us some of the high points, a sneak peek as to some of the thoughts that you'll be sharing today.
Yes, so it's no secret that electronic trading is growing in fixed income markets, corporate bonds, and swaps and government bonds. I think that's pretty well known at this point. We do talk a bit about that. But really, I think what's interesting is the opportunity there is now for emerging deals, for middle market dealers. They build their business on their relationships. They put out unique content, so there's a lot of opportunity for them since the crisis, as the bulge bracket has really entrenched and focused on particular parts of the business. That said, the bulge bracket always had a technology advantage, right? They would spend money on auto quoting and internalization of trades and analytics and data, things that to a large extent for a lot of those deals were out of reach. They didn't have the teams, they didn't have tech teams, compliance teams that were needed to build those systems. And what we found was there is a lot of opportunity now to finally buy some of those components and put them together. We see that in trends in a variety of places. Auto quoting is one, trading systems is another, where the off-the-shelf software really is right up there with what the bulge bracket is building and providing opportunities for a lot of the rest of the market.
So the market, obviously, for many, many years has been dominated by 5 firms. And part of that is strength of balance sheet, breadth of client base, the depth of pockets, if you will, in terms of that technology spend. But what is some of the key decision in going to those mid-markets now that are saying, hey, maybe I can disrupt this market? Is it the availability of technology? Is it client demand? What do you see some of those key drivers behind that mid-market investment?
Yeah, and I think so interesting is that if you look post-Dodd-Frank, in some ways the market's gotten more concentrated with the top 5. So we show about 60% of client volume in corporate bonds, for instance, is traded with the top 5. But what's changed is that sort of the rest, like the long tail of dealers, has gotten much, much longer. So most of the major investment firms do work with at least one of those 5, probably more of them than that. But when it comes to sector specialty or understanding of a region or particular corporates, or even just more of a high-touch relationship, increasingly they're looking to this broader group, right? Just going sort of on down the line into regional and middle market dealers. And technology has allowed some of those middle market dealers to get that distribution that they wouldn't have had otherwise. If you need to build a relationship by phone, you need to know who to call. If you can respond aggressively on pricing on a system, that allows you to compete with those top tier firms and start that relationship, right? That one trade could start that bigger relationship, and we are seeing more and more of that because that technology is now available to allow them to do that.
And one of the areas we always talk about is disruption. Disruption from fintech, disruption internally to your own systems. What role are non-bank liquidity providers playing as a disruptive force in fixed income market making?
Yeah, so there's 2 different stories there. I think in the treasury market, you have more traditional, what we would have in the past referred to as high-frequency traders, making markets in a variety of places there, right? Very fast quoting, smaller sizes. But that's in what was traditionally the inter-dealer market, and that's changed quite a bit. We also then on the corporate bond side, that's a little bit different. There's a huge influx of trading from the ETF market makers, which are starting to have a big influence because they're arbitraging ETFs to the underlying corporate bonds. They're also willing to hold some inventory, to hold some bonds, which wasn't the case only a couple of years ago. That means a lot more turnover, and the turnover from them is good because then that provides more liquidity both for the bigger dealers, so they have somebody else to trade with, but then obviously also for the clients. The more those bonds are trading, the more the pricing is transparent. And then hopefully the easier it is for investors to get their orders done in the long run.
Well, Kevin, I want to thank you so much for joining us. I know you're going to be talking to the audience in just a few minutes. And of course, the report is available on numerics.com as well as GreenwichAssociates.com. Please follow Kevin on Twitter at
KMcPartland.
KMcPartland on Twitter, and check out his blogs on Greenwich. And of course, we always want to talk about the topics you want to talk about. Follow us on LinkedIn or at NX Analytics on Twitter. Thanks so much. I'm Jim Jockle. Talk to you soon.